Thank you all for coming. I really appreciate it. For those of you that don't know me, I'm Eddie Beqaj, Chief Revenue Officer at Flinks. I'm going to start with a number tonight, and the number is 24. And Kiefer Sutherland did not register for the event, so not that 24. 24% is the number of Canadians that switched bank accounts last year. Environics has been running their national banking study for 20 years, and that's the most in that time frame. 24 happens to also be the amount of months that it takes on average for a fintech and a financial institution to partner together, from prospecting, that first meeting, all the way through to signature. And 42% of those, which is 24 backwards, fail before they even become technically viable. Not because of the product, not because of the market, but the integration is what broke them. So that's what we're here to talk about tonight. We have a panel from the big banks to the fintechs and everything in between to discuss how we, as the Canadian fintech ecosystem, do more together. Because as the old proverb goes, if you want to go fast, go alone. And if you want to go far, go together. So it's my honor to introduce the panel for this evening. Pesh Patel, VP at CIBC. He understands what it's like and have pressure to innovate in a big five, big six bank. We have Michael from Financeit, who built their business around FI distribution. And he knows firsthand what successful partnerships look like and what those that fail look like as well. And to moderate the fist fight, we have Monisha, the CRO from FIG, who sits at the intersection of both of these parties. So without further ado, thank you all for coming, and over to them.
Very excited to be here. What an evening. First of all, first day that feels like spring. It was nice to get out there with the sun beaming. Fantastic venue. Thank you for Flinks for organizing this and getting us all smart people in a room together. The purpose of this is not to be like your traditional panel. I think you get a bunch of smart people in a room. You let them just run with the conversation. That's what we want to do tonight. If any of you have any questions at any point in time, just raise your hands. We'll get to it. This is meant to be an intimate conversation, as intimate as it can be with our closest friends. Anything you've been thinking about, anything pressing that you've been wanting to ask, feel free to ask. I always joke, I'm very passionate about financial literacy. I have this book that I wrote that I went to schools to talk about. And after I read the whole book, I was like, any questions? I'm like, oh, this is going to be so great. These are 4-year-olds, so context. Someone raised their hand. I'm like, this is great. Another person, I'm like, this is great. 5 people, great. I go to the first one. What's your question? I really like mayo sandwiches. Can I eat mayo sandwiches every day? It was not relevant to the discussion, and I kind of take that to say, you might have burning questions that may not be relevant to the discussion. So it's the mayo sandwich test. If you find yourself asking a question, you're like, is it the mayo sandwich? Maybe that's late for a later conversation. But outside of that, anything goes, and we're happy to have a chat. I know that Eddie already started us off with some data. I'll throw some as well. I told these guys I'm going to ground the conversation in data, but they heard me say I'm going to drown them with data, so I'm going to try not to do that. But yes, globally, right? Forget Canada. Globally, according to Accenture, now take it with a grain of salt, it's self-reported, 90% of all banks say, we want to work with fintechs. This is great. And on average, globally, a study by Bain says, a bank works with 9.4, very precise, 9.4 fintechs. However, the same study says only a third of those engagements, so a third, 3 fintech engagements, are perceived to have returned value. So we all know, we live in Canada. It is probably the most concentrated banking, one of the G7 countries that we have globally, where banks dominate when it comes to distribution, when it comes to brand, when it comes to that power that they've spent a long, long time amassing. And that's their DNA, their stability, their security. And on the flip side of it, we've got fintechs that are trying to change that landscape. And the DNA is a little bit different. It's not stability, it's velocity. It's looking to power through and innovate. But in the story in Canada has been a lot more about collaboration by need, it would feel, because the way that Canadians are, because how conservative they are. So I guess the question comes back to both these esteemed panelists that we have today. If you were to strip out the press releases, the strategic decks, everything we put together, why do you get into a partnership? What does it matter? And Pesh, we'll start with you. What is the strategic imperative outside of quote unquote innovation theater to look good, maybe to increase your shareholder expectations? But what is the true strategic imperative to partner with a fintech?
Well, evening everyone. First, can I just say, mayo is actually the only food that I absolutely hate on the entire planet. It's the one thing that can just absolutely go to hell. So well done to that kid for raising. So I think the answer is really, really simple from a big organization perspective is we often think everything that any fintech can do, we can do ourselves. We could do it. The challenge and the question that or the two questions I suppose we'd really ask ourselves is, one, do we really want to do it ourselves? Which means, do we want to go to the effort of learning about this new thing, figuring out what it is, figuring out where it fits in the market, then build it, then try to go to market? And quite often the answer is, we could do it, but it would take such a long time and take so long to implement that everybody would have moved on by then. And then the other thing is simply about speed to market. So even if we did decide that we wanted to do it, if there was a way that we could do it that was easier and quicker, that's fundamentally it. I'd make an argument that, and you'll see I've worn my most boring suit today to really be the boring bank person, and I put on a British accent to make it seem like I'm the bad guy. But quite often you get a lot of old execs at banks, and one of the things that old execs love to do is to be cool. And that's sometimes a reason that we look for fintechs, right? We're looking for new ideas, ways of working that will help us be cooler, be more effective. I stumbled upon an article by, or it was actually a podcast by that interviewed the CEO of DBS Bank in Singapore. And one of the interesting things that he was referring to as he was taking in the glory of being voted the best bank in the world 5 years in a row, was that one of the questions he asks his team is, how can we operate more like a fintech? Which is an odd statement really, but it's obviously a reflection of the fact that fintechs operate in a very different way. They think of problems in a different way. They think about how to solve those problems in a different way. And compared to a big bank, they're often unburdened by some of the things that we concern ourselves with. I spend 90% of my time thinking about very, very boring things. Regulations, compliance, how not to break the law, how to create something that is for 10 million clients. And if you're not burdened by that, you can create and you can be innovative. So as soon as something innovative comes along, that's when those first 2 points that I made kind of come into play, and we can start to do great things.
Yeah. Do you agree, Michael? Do you think it is the coolness factor, or do you think it's grounded in something real?
Well, there's only one guy up here wearing jeans. Just saying. Okay. I mean, obviously, so cool. So, I agree. So we've been doing this for a long time. Financeit started. We first loan on the books through a bank partnership in 2011, and that one was an insanely hard partnership to land because we had no background data to share with anybody. We had no credibility. We didn't even have enough capital at that point to fulfill the entire servicing of the loan that we were going to originate and manage for that banking partner. And so there's like a lot of risk. And I've had, I don't know, maybe 100 bank conversations since I started the company back then. And we get excited around a bank saying, you know what, we totally get it. We suck at doing small things, doing anything innovative, going fast. We still want to work with you. And then they invite risk and compliance and other people in the room. I'm like, oh my God, who invited those people? Unless you guys work in those departments, and then they're awesome, by the way. Super awesome departments. We love them. And they look at the things, at a fintech with the eyes, prudent eyes. That's your job. You go in, you're in compliance, you're in risk management, you're in vendor management, and you look at this company and you say, there's no good reason for us to take a risk with an organization like this unless there's a steward that says, okay, if we get this right, there's a gigantic net interest margin gain that we get. There's a gigantic moat that we could create in a small part of the ecosystem as a result of partnering with a fintech. Because in the end of the day, let's just be frank, banking is a commodity. Almost every single thing within banking, one of the 6 colors you can choose from at Bay & King offer the exact same product at almost the exact same price. And so the opportunity is to partner with a set of entities that can give you an innovation angle. And what we'd always argue is you're going to have to bear some type of risk in order to get there, because if it was easy, one of the other 6 colors would already have done it, right? And so that's kind of how, and that already sets us up. We're already antagonistic from the but partner antagonistic from the very beginning.
I love it. So I think we'll dig a little bit deeper, right? So as I mentioned, the Bain study said a third of all relationships, all partnerships, so this it already feels like a relationship, tend to fail. If you were to dig into that, Pesh, why? And I'll add a little bit too is, what is even success?
Oh, well, yeah, well, two very different questions. I'd equate it to marriage. When a marriage breaks down, it's never one side's fault. It's always a little bit on each side. So I think quite often the thing that, before you get into the relationship, there are things that you don't know about each other. Oh, this is good, really taking the marriage analogy too far. But when a bank enters into a relationship with a fintech, there are things that we don't know about each other, how we operate, what our risk profiles are, who has SOC 2 compliance, all of this kind of thing that you get to in the detail after the deal has been signed. And it's at that moment that you really try, or it's in those moments after that you figure out whether you can work together, whether you can work together on the thing that you've agreed to do, or whether it's something that you think can extend beyond that into other things that you can go and build. And so it's always a kind of learning relationship between the two. The big challenge is really to get across that first hurdle of doing that first handshake and making sure that it's mutually beneficial to both, and trying to figure out how to navigate that complex ecosystem of compliance and guardrails and international laws and various other things that you can kind of get to. I would really make a really simple argument about what makes it successful. You both make money. And that's you both make money and nobody goes to jail. I suppose I should add that part.
Just like marriage.
Just like marriage, exactly. Yeah.
And I would say that maybe I'll ask and lean into that relationship. Do you feel that the courtship between a big bank and a fintech is stuck in the Victorian Regency era? And when can we bring it to current age, maybe Tinder era? Like if you think about the time to getting that relationship, time to saying yes, how do you think about things that the banks should do, could do? It's been decades and I feel we still have the same conversation. Oh, a bank, you're gonna, like I remember I've been in fintechs, you have a conversation, we're like, this is great. They're really excited about this. 12 months later, they're still excited about it. And you're like, how could they still be excited about it? It's been 12 months. So how do you break that down for us?
Well, I can tell you the Department of Finance is still excited about open banking.
So excited. Yeah, so excited.
And Michael, have you had horror stories of this where you go in and people are excited and it's like been 10 years and they're still excited and want to work with you?
Yeah, like other than open banking, you mean? I've been on that file for 11 years. I was saying to somebody earlier, I'm off the file. I'm so frustrated. But leaving all that as an aside, so here would be my recommendation. We have fintechs in the room, right? Are there fintechs? Can you just put your hand up if you're a fintech? Fintechs in the room. Okay, yeah, there's some sheepish fintechs there. They're like, maybe I am a fintech. Okay, good. So here would be my recommendation.
They didn't want me to be scared of them.
I know, seriously. Here would be my recommendation. And just to put like scale in context of us as a fintech, we've been called the OG of fintechs because we've been around for so long. I don't think that's a compliment. I don't think that's a compliment. I used to whenever someone called me OG, I'm like, just call me an old guy? That is so not cool.
That's what OG stands for.
That's what I was like, old guy. That's not cool, dude. But that's not what it stands for. So for some of you folks that are at a smaller scale, and I'll flash to our scale. So we do about $2 billion a year in lending on our platform. We have a book of about $4 billion in loans that we manage. All of those loans are given to a bank at some point, or a financial partner at some point. Could be an insurance company. Almost everyone we give loans to are regulated, right? And suffer from all the regulatory challenges that you would hear from any big bank that's in the room, big or small bank that's in the room. And we'll do about $500 million in top line this year. We'll do about $120 million in EBITDA. That just give you a sense of scale. We're big. We're a big fintech in Canada. We've been at this for a very long time. We have 7 or 8 different banking partners that we currently work with, and 100 bank conversations that we've had historically, right? Including here. And I don't really have a relationship here, so it's really unfortunate. But here's what I would tell you about finding the Venn diagram between the bank, if we can juxtaposition ourselves here as a Venn diagram, The bank's need for, I want to innovate, I want to make money, I don't want to go to jail, I want to stay on the right side of our regulator, I don't want to get fired from having chosen to work with you, and that was a terrible career decision for me, right? So there's all of these things that are in the bucket of the things that a bank wants. Then there's all the stuff that a fintech wants, right? We need a balance sheet. We need to be able to have a partnership that's going to grow and scale. We can't get bogged down with like bank bullshit, right? We got to be able to move fast, like all the things like in our bucket. And then you got to find a way from the first meeting, which is usually between a guy like this and a guy like me, and we get all excited about what we can do together. And then the more people that come into the room, the more like the Venn starts to rip apart, right? And like where we're going to find things that are common. And the first big bank partnerships you're gonna work on, don't let perfection be the enemy of good enough, would be my biggest recommendation that I make to you. You're gonna get an ultimate contract that works with the bank that is gonna be filled with caveats, it's gonna be one-sided, they can leave, you can't, one of your children has to be theirs, like all the shit that's gonna be in this contract, and you're gonna look at it and you're like, who would sign this? And the answer is a desperate fintech that actually needs to get off the ground or to scale their business. That's who's going to sign it. That's you. You're going to suck it up and you're going to sign a shitty contract and you're going to outgrow it because the next bank is going to make it a little bit better and the next bank is going to make it a little bit better. And your job is to survive and to find a way to scale and to reduce the time frame. What number did you use? Like 24 months? Was somebody use that?
Eddie had that.
That was Eddie. It was Eddie's number. Yeah, 24 months. 24 months is too long. You're gonna die, right? And so don't die is my number one thing I tell all fintech entrepreneurs. So that's how I would recommend. Suck it up, close your eyes, sign it, get back on the street, try to do better on the next contract.
And if you guys think about the partnerships that you have seen, now we say 9.4, I guess the first question is, do we feel that's true? Do we think, I mean, I could take a poll. Do you think on average Canadian banks, I don't have the Canadian number, but do we think on average Canadian banks partner with 9.4 fintechs? What's the general perception? This is a room of people that are very much, educated about this space. Anybody think more than 9, less than 9? Less? Do we all think less than 9?
But we had this discussion, so widen it out.
But let's just. So do we think 2?
3.
We think 3. We think everybody is saying 3 fintech partnerships. And so go ahead, Michael. I'll let you expand that.
So if we expanded that to like utilities, not just platforms. So working with a platform like ours, that's a big bite. But working with a Flinks, not such a big bite, right? Necessarily to get started. There's a set of utilities that they have that are just really useful. You don't have to do everything that they offer, right? You should, Eddie says, but you don't have to. So there's lots of easy ways, like Onfido, which lots of banks use for some of their online mortgage application activity. That is a fintech, right? So Visa is a fintech, just so we're clear. FIS Global is a fintech. So if you add in all of these sort of utility and banking platforms, you probably get to 9. CIBC probably gets to 9.
Cannot disclose that information. Yeah, I think you're right. It probably does get into that category, and I think it's an interesting point to kind of think about. Really, is that definition of fintech is pretty broad, and you can kind of think of it in many different ways. From a bank's point of view, we often just think of who we will partner with and what is it that partner can potentially bring to the organization that we don't already have. Fundamentally the size of the organization is a risk factor. If you want to go into a strategic relationship with a tiny, tiny company with 10 people and you're building something that's going to scale to 5 million clients, then you have to acknowledge that somebody somewhere is going to be filling in a spreadsheet to say that fintech could go under tomorrow, and what are you going to do then? And so really it's that size is a kind of factor. I just want to go back to one other point that you made. You made some really good points around what a fintech might want to do when they think about banking relationships and who they bank with in their first kind of contract. The other thing, one thing I would really recommend, I suppose I've had this experience both here in New York and in the UK, is that quite often executives in banks have grand job titles, just like I've got a really grand job title. It's like 15 words. but it doesn't necessarily mean I have much authority to do anything. And I would honestly make the argument that the hardest challenge is to navigate that jungle of people in the bank and find the right person, that person who can actually make the decision. Because whilst we're right, yes, there's lots of spreadsheets and compliance, and the more people you bring in, the more challenging it is. You start to get legal info contracts, all that kind of stuff. That can be made really easy if it's the right person in the bank saying, yes, sign this contract. And then it'll become a lot smoother. If that person is I think this is going to be quite a good relationship, but we better make sure the contract's good, and we better do a full assessment of the company, and we better look at the viability of the relationship, and we better do a full RFI. All of that kind of stuff just means all of those other people that get involved are operating with a different mandate. They're operating with a mandate of, I can stop this whenever I want. Whereas, well, maybe I won't talk about me, but if the question is asked a different way, make this happen, please, then it will happen as long as you found the right person. So that's definitely my recommendation. I know quite a lot of you guys at Fintechs have this kind of struggle to get in the door, and it's now more of a struggle, because now not only have you got to get in the door, you've got to try to figure out who's who and which is the right person that you need to get in touch with to try to get things moving, because otherwise you do get yeah, we're really interested. Yeah, come on, take us out for another steak lunch. Yeah, we're interested. 12 months later and still nothing happens. So definitely take that approach of finding that right decision maker.
So it sounds a little bit like death by committee, right? Like there's a lot of 1,000 paper cuts, whichever analogy you want to pick. If you think both of you in your careers, something that has gone the perfect way, you're like, I wish every conversation, every transaction, every deal went this way. Either of you can begin. Like, is there something that you're like, you know what, this was perfect? And on the flip side, I would love to hear the opposite. Something that was absolutely the worst nightmare, and you're like, if I could go back, I would never talk to that person again.
I could talk about 2 meetings I've had this week that fall
You'll never talk to them again.
Right? So the first is when you speak to a potential partner and they try to make the sales pitch. They make the sales pitch. We can do all of these things. And as part of just pressing on that a little bit, you ask, but what about this? And how are you architects? And how will you deal with this problem? Quite often those kind of first order questions are pushed back by the selling party to say, we can work through the details. I'll bring my CTO to the next meeting but when the meeting goes really well, is that the people there can answer those questions. They can even, the meeting that I had earlier this week, a potential partner just said, can we find a room with a whiteboard? I'll show you exactly how it works. Which, they're speaking my language because that's what I love to do. So they took me into a room, they drew on the whiteboard how the technology architecture worked, they drew how the flow would work, what the journey would look like. And this was amazing. It was really amazing, and really had me build the confidence in the ability for us to partner. Conversely, I won't tell you who it is, but we are in a long-standing relationship with a fintech where they've grown and they've grown and they've grown, and they've now become just like any other big partner, where everything that you would like to get done is a change request, is 4 months worth of analysis, is $100,000 just to bring people around the table to talk about the problem. And in those conversations, the people that they send to you don't know anything about how anything works. And that's the most frustrating thing, when people are brought to just be salespeople, but they don't actually know anything about what they're selling, why they're selling it, why it's important, which I think, luckily for fintechs, you don't often have that, because most of the salespeople know what the business is. But that's the absolute worst, when they just don't know what they're trying to sell.
Michael.
Sure, I'll give an example. I'll give the perfect example, and then I'll give the terrible example. And I'll try to do both with a story. So the first example, we were in the early days of the business, growing into point of sale lending. That's what we do, point of sale lending for the home improvement industry. We had a competitor, TD Bank, that was in this business. And I think they picked up this little home improvement business through an acquisition, and they were bumping along. We were literally kicking their ass every day. That was our job, just went in and found their customer list and just kicked their ass every day. That's what we were really focused on. And then one of our investors was a former senior person at TD. He's like, why don't we just go buy this business from them? For sure, this thing is too small for them to care about. You're kicking their ass, right? No one wants to put their neck out on this thing. Let's go buy it from them. And And so we started in a conversation. That conversation like took a long time to sort of get to the right person and figure out what the right price was. You got this sense that a bank would rather kill a thing than have to say they failed at it. And so we had to get over that type of stuff. And we got a deal, essentially a framework of a deal for how it was that we were going to buy this thing. But their request was, hey, you don't just buy the little business that we have, this business unit. You actually have to buy the book of business as well. There's 350 million loans, 350 million in loans that you're going to buy as if you want the business. And we were like, well, $350 million. Like we maybe had $8 million in the bank that were meant to be operational capital. And we're like, this is not a good deal. And so we went to one of our banking partners that we had, and the banking partner that we had was super hungry for these assets. They were like, we're excited about these assets. So we'll be your partner on this deal, and we'll buy these loans at par from TD, because TD is obviously a good bank. These are servicing loans. Not only will we give you the 100 and 150 million that you want for your balance sheet this year for net new loans, we'll give you 350 million to buy these loans. So subsequently, we just ended up working on this deal. We showed up with like a big balance sheet, so we looked super cool and much bigger than we were. And we ultimately got this deal done where we bought this business that was bigger than our business. And cash out of our pockets was nothing in the end, because we had a servicing contract and then we borrowed the money for the additional amount that we had to pay for the TD deal, and it was all essentially like future revenue from servicing. So we doubled the size of the business, which gave us like, I don't know, maybe 100 million in enterprise value, and we parted with zero money. We took a ton of risk. We ended up structuring that deal so that if all the loans went south, they'd own the company. So that was a kind of a bad provision, but it protected them in the case of like a downside risk. And that's how we got that deal done. And so that's my example of like a perfect partnership where you go, you're aligned on interests. They were super hungry. They couldn't figure out how to do this themselves. Even if they were to do it, they wouldn't know how to ingest the loans. They wouldn't know how to service in the home improvement industry. There were a whole bunch of reasons where we were perfect partners. And we literally like doubled our EV on that deal with no cash out. I'll never do a smarter deal than that. I know it. I'll give you the other example. So Goldman Sachs invested in our company at one point. They became a majority investor. And their thing was, hey, this thing in Canada, super cute. Honestly, super cute. You know what'd be way cooler is if you launched this in the US, and way cooler if you took this new bank that we've just developed called Marcus, which is going to be gigantic. And we're going to map this Marcus thing to your business, and we're going to shoot you to the moon. Like, there's you, Garrity, you're just go, out to the moon you go, right? And I was like, oh, this sounds fantastic, right? You're investing in the company, you're going to give me a balance sheet, you're going to help me launch in the United States. This thing is fantastic. So 2 years later, $10 million of capital sunk in this thing. We're like, can't find a way to get launched in the US because Marcus has made the same promise to like 8 other companies, like at the top of which was Apple, right? And so there's Apple, and then like way down the list, there's Financeit. And we just kept struggling, and I kept holding on to hope because I'm relentlessly optimistic. And they're like, you got to move to New York, and like you got to live here, you got to hang with us in Tribeca. And I'm like, yeah, man. Then I look at Tribeca real estate, I'm like, no, man, you got to move to Dumbo. So we end up like in this endless conversation, $10 million. My whole team are in revolt back home because I'm the one who's led this initiative on behalf of the company, and it's killing us. Like, it's absolutely killing us. And then a Friday afternoon, I get a call from the managing partner who says, hey, kind of a bummer. He had an English accent too, by the way. I should get you to play this role so I can just be really mad at you instead of being mad at him. And he's like, hey, Michael, kind of a bummer. I know it's Friday afternoon, but we've made the decision. We're going to end this project, and we're also going to put the company up for sale. I know it's kind of a bummer. Have a good weekend. I'm like, whoa. Can we go back to the shitty part of this conversation where you are like, what is happening? Anyway, we ended up in this very long, difficult conversation. They had made the decision, the new CEO of Goldman, to buy a company that operated in the space in the US already, and this would be a direct conflict of interest, and therefore they had to get out. So there's 2 years, $10 million, probably way more in actual cost that it took. a massive disruption and setback for the company, and it ended up essentially in a breakage of the partnership completely.
So, I mean, and these are fascinating, and I think everybody can listen to Michael tell stories all night, and you can. The night's still young. But I think that the challenge here, it seems to me, is a lot of, I think when you talk about courtship and relationships, is it's one thing to get yes, right? It's one thing to get somebody to agree to marry you, and then to stay married and have the marriage work, well, that's a whole another set of commitment, right? So what do you guys find is the ingredient to a successful partnership? Like it's one thing to get things through the door, and I think we kind of talked about it a little bit. What do you measure success, right? So maybe in a marriage, it's easy, you're together, and you celebrate your anniversary, you're like, that's great, that's success. What is success in a fintech FI partnership? Is it just money? Is it just revenue? Is it stickiness? Is it retention? Does it depend? Is that always the right answer? Like, what is success? And I mean, we can start on the fintech. What is success when it comes to like, hey, this is how I look at that, and this is a great deal. This is successful as a partnership.
Yeah, well, I mean, I use the example of what a really wildly successful partnership looks like, but I think like it really depends on the stage. So I'm also lucky enough now to be an angel investor with a whole bunch of other people in a early stage fintech investment firm. And what I tell a lot of these young entrepreneurs is your job is not to not die, right? Like, don't take your idea to the grave with you. Have your idea turn into a company. And so do whatever deal, as ugly as it might be, to move to the next milestone. But be so clear on where it is you want to end up. Your job isn't done when you form that first partnership, because it's not a sustainable partnership. Your job is to get to the next partnership and the next partnership, and what you're going to find is that way better third partnership will force that first partnership to be better, right? Because you now have some leverage on how it is that you're going to evolve things. So I think, like, be realistic about how you're going to get started, and just be really realistic about where you need to get to. And your job is to never give up. Like, you just got to make improvements, make improvements, make improvements. We're on year 13. We still go back to every one of our bank partnerships and squeeze them a little more, right? Like, that's our job, because they squeeze the hell out of us at the beginning. It's our turn now, right? And so, yeah, that's what we do. And I do it in a friendly way. We all do it in a friendly way. But we have a lot more leverage on the market, and those partnerships understand that we have more leverage, and we take advantage of it.
That makes sense. And Pesh, what do you think makes a strong partnership? What are the key ingredients to success?
Don't like
and also how you measure it.
You're going to give Flinks some bad ideas. I think for me, something about the longevity of the relationship is the way in which we both grow together. So yes, the banks are big, but the way in which our business can grow in partnerships with fintechs is hugely important. And quite often, the partnership starts off with the idea to solve this problem, this one thing over here. And the thing that fintechs can do really, really well is not only solve that problem, but get a little bit more attuned to how the bank operates. Similar thing to what I said before around who the decision makers are. Get a much better idea of what our problems are, things that we do well, things that we do poorly, areas that we've seen, issues testing new solutions, where we've seen low adoption, and it all helps in the next solution that gets pitched, because then the next solution is already made with the idea that, hey, we know how you operate. Given that, here's how we can help this line of business and kind of continue to grow at that pace. And then similarly, just like you said, there's definitely the balance of the relationship that starts to shift. And even though that might seem like it's advantageous towards the fintech and kind of hinders the bank a little bit, actually the bank's really happy when everybody's just making money and minimizing the risk of that revenue generation. So that kind of growth has to be kind of strategic, has to be diversified, because quite often fintechs do one small thing really, really, really well at the start. Banks do lots of things, arguably poorly, but they do lots and lots and lots of different things. And the speed and the kind of innovation, or the innovative style with which fintechs can do those changes, means that they're in a position, once they've got their foot in the door, to help with loads of problems that maybe the fintech didn't think they would be able to help solve when they first started or when they first walked in the bank's door, but actually can, because they now see a little bit more about how that bank operates.
I'll put this as the last question we open up to the audience. Do you think that is the ultimate goal of these partnerships, for the fintech to get acquired by the big banks?
Yes. Just kidding. Just kidding, because we haven't been acquired by a bank. But in our last sale process, there were a couple of banks that were at the table with an active interest in the business. And so there's nothing wrong with this, by the way. Banks don't do, any big organization doesn't do small well. This is universally true, whether you're in the telco industry, whether you're a financial institution, your insurance company, you just aren't built to do small, innovative things quickly. You're just not built for that, right? You operate at scale. And I think your story is a good one. Even these fintechs that get to scale, they stop being able to do small, innovative things quickly because you just aren't built for that anymore. You end up being much more about protecting this thing that you've created rather than innovating constantly on this thing that you've created. And so that's good news for everybody in this room who put their hand up earlier. Fintechs can be small and nimble, focused, quick. You can build things. What you aren't is at scale. And so if you can manage to get in to an ecosystem that banks, insurance companies, wealth management entities, anyone at scale, and be able to prove your worth and be able to build some scale to it, you will naturally be an acquisition target. That's good. That's great news. We need a hell of a lot more of those in Canada, in my opinion, and we need a bunch of those ones to go public as well, so that we not just share with a bank the proceeds and your management team, but also we can syndicate this out to retail investors and be us all so lucky as to build that kind of scale. So I don't think there's anything you should shy away from, and I think banks, if you're big banks and you're in this room and you got big checks to write, hell yeah.
Pesh, any thoughts?
Yeah, I do not have a big check to write.
Come on.
Yeah. No, so completely agree. I think that's one of the things that actually, conversely from a bank, is something that is a position of risk when it comes to going into a relationship with a fintech is, do I think this fintech is still going to be around in 5 years? Because the likelihood is, exactly to the point that we've been making about, you get your foot in the door with your first bank or your first big relationship, you get the second one, the second, third, and fourth become a lot easier. Suddenly you become pretty big. Suddenly become much more attractive for purchase. Then you just might get swallowed up. And so I think there's an interesting kind of middle ground when it comes to, certainly for me, what an ideal relationship looks like. And if it is a position where I'm going to my board of directors and saying, we really need to get into this partnership, but I think that organization might be swallowed up by someone else in 18 months. And it's a bit of a tougher question to be answered. I would say also there's kind of different personalities of fintechs, right? Some want to be like that. They want to be this kind of flash in the pan. Everybody on the board makes a huge amount of money and then it disappears because it's been sucked up. But quite a lot do want to exist and grow organically and build new capabilities and just be a big, long-standing Canadian company, which I think is great. And I think I've never worked for a fintech, but I'd be interested to understand how the philosophy of these organizations kind of either starts and then grows and changes depending on the types of relationships that they have. And I can say that, working at CIBC, and we've just got a new CEO, just started November the 1st. The culture of our organization, 48,000 people, is starting to change to accommodate the fact there's one new person at the top. And fintech kind of change more quickly than that. And things change very, very rapidly. So I think it's important, especially as you start to grow, that you have a philosophy that you can then stick to. And that will just help you achieve your targets, whatever they are.
Thank you for that. Wise words. We'll open it up. Any questions in the audience?
Hi. I'm Liz from Block.
Hi, Liz.
I'm still employed. Too soon? No. So just a question. I mean, the U.S. is so much more aggressive, bigger market, more competition. I've heard many, many times over the last year or two how hard it is to build things in Canada, and that in and of itself is a moat. I think we need more fintechs in Canada. We need to be able to move faster. I would just love to get your collective perspectives on what we actually need to do to achieve that in Canada, because I don't think that there's enough of it when I look into market.
Well, I'll start. I get to see a ton of it, right? So because I'm in a venture firm, I just joined a board, a great board, Slate, HQ, B2B lender, embedded in CRM platforms as a way to get better data, make better decisions, get paid faster. Awesome group. There's a bunch of those companies in Canada as well. And so in each time we are looking at a particular investment thesis, we also go and do a competitive analysis and say, hey, who else is doing this? Like Loop is in there. There's a whole bunch of other folks in there. Like Block, Square, Credit, which is what it used to be called back when I understood it. Like, again, great model. Embed into the ecosystem, make better decisions, get paid faster. Like, banks can't compete in that type of SMB lending. So I see a lot of startups in the ecosystem and in Canada. I mean, look, we don't have as much capital here as they do in the United States, and it's not like 10 to 1, it's like 100 to 1. The difference between available investment capital out of the US versus available investment capital in Canada. I think we have a small number of banks versus whatever, 4,000 banks in the US. Banks in the US are much more competitive with each other, so therefore it's easier to establish banking relationships to try to get a leg up on what some of the other banks. And I'll tell you, because I'm part of the C100 as well, which is like a Canada-US bridge thing to help Canadian companies be more successful. We're never going to replicate the cowboy nature of the United States. Now, maybe that's a good thing, right? But at the same time, for our ecosystem, we're trying to learn as many lessons as we can from our southern neighbors on the best of them, right? A risk appetite, an ability to try and fail, get back up, don't take it personally, just keep going, raise capital, go, don't sit around. And I think we're active in the conversation with our portfolio companies to say, like, come on, just go, just get going, hurry up, take shitty contracts, keep moving, right? Don't die. So we're trying to engender that, but there is, I'll tell you encouragingly, there's lots of stuff that we see happening right now.
I'll add to that. I think one of the challenges, and I've been on both sides as well, I see is actually the Canadian consumer. The Canadian consumer is not like the American consumer. Therefore, Canadian businesses cannot be like American businesses. A Canadian, when I was in Credit Karma, we were building it out. Actually, I'll do this. Show of hands. How many credit cards do you think are bought online in the UK? Just only online. I go online, I buy a credit card. What percentage? Any number, anybody? 10%, 20%, what do you guys think? Online. 80%. 80% of all credit cards bought in the UK are bought online. When we started Credit Karma in Canada, it was like 30% of Canadians would be comfortable. During COVID, this is like my favorite stat of COVID. During COVID, a third of all retail branches had to be open. Do you know what that means? Canadians would rather die than not go to a branch. That's what that means. And that is a very different consumer. In the US, it used to be 58, 60%. Canadians have been dragged into the digital adoption era. And immigrants and first-generation immigrants, new folks coming to Canada, heavily have been pushing because they come from other parts of the world where you expect digital engagement. The longest time, Canadians are like, what's wrong with going to a branch? And so it's very, very difficult to build a business that is a rocket ship in Canada. And we cannot build a sexy rocket ship business. You will not attract the funding dollars. And it makes things a lot harder. Even for us, like at FIG, we do personal, completely online digital lending. And I'm like, this is great. Every time anybody comes from the US to Canada, it's like, oh, Canada's like the US, just 10 years behind. And they keep saying that for 10 years. And that's a bit of a problem, right? Because I look back and I'm like, oh, this is just like Lending Club, but 10 years ago. But it takes a long time. Canadians' life cycle of purchase is 2 to 3 times the American life cycle of purchase. And that makes a difference in how quickly you can build and how quickly you can scale.
I think I'm going to make an impassioned defense of Canadians. I think you're absolutely right that in the industry there is this perception that things are moving very, very slowly. Generally, it's nothing to do with fintechs. Generally, things move very slowly. I'm going to lay the blame a little bit at governments and regulations. I think there's a hell of a lot more that we could be doing to just get out of the way. Just let the innovation happen. I see more innovation in Canada. There's a lot more international interest in innovation in Canada than there is from Canadians. There are lots of people outside of Canada who want to invest in Canadians who are themselves innovative. But there are, like, we use open banking as the obvious example. It's 2026. Why are the governments still thinking about it? Why do they need to spend 6 years thinking of what the technical standard might be for data transfer? Just pick something and let us get on with it. And the fact that they don't just means a lot of those sparks die before they get a chance for anybody to participate. It's just going to take one or two big things to come along, and we just need to make sure that we let those one or two big things happen.
So you think Pesh works at a fintech? He's so optimistic. Any other questions? I think there's one more. Yeah, go ahead.
Mostly for Pesh, but Michael as well. Because we are moving so quickly into open banking and open finance and open data, if you had to put yourself a few years in the future, like, do you think that having the standards in place, everything else, will that make partnering dramatically easier, or do you think that it will still look and feel the same?
Well, I think it's a really interesting question, because I think on the face of it, yes, because now, from a bank's point of view at least, the standards that we have to determine ourselves to drive whether or not we think it's a good idea to get involved in a partnership have now been standardized, at least to a certain extent. So data sharing, liability, the standard that an organization has to be at to participate in an open banking ecosystem has already been met, which makes it a lot easier. That said, if a fintech is already involved in this ecosystem, then why would they want to partner? Right? So now you're in a different kind of paradigm where now your conversation is more about, would it be useful to be bought out by a bank to try to have that service? So I think technically the answer is yes. It makes it a lot easier for a bank to consider that partnership, but it does change the kind of power balance of what access a fintech can have to Canadians. And because it increases that so dramatically, or at least in theory it increases it so dramatically, it does change the value that banks add to fintechs in that paradigm.
And I think we'll close with the last question. Oh, maybe we'll sneak one in. We'll see.
So I'll take Matthew's question, make it a little trickier. Jane Barrett, MX, also the co-chair of the Financial Data Exchange Board. So yes, pick a standard anytime soon would be good. But there is a risk in Canada, and I got to say, kudos, we didn't talk about AI. It's like the only panel in the last 5 years that didn't go there. But there is a risk in not having the infrastructure in place, where you've now got global platforms where agents can be deployed, where you've got people who are used to putting their credentials in to get something done, that now they're uploading that into AI agents. Like, how are you guys thinking about that from a less so regulatory risk, but more just like business risk, where, how can you be, like all of us potentially, getting disintermediated by agents?
Oh, it's a really tough question that we are struggling with at various levels across the bank, front office to back office, because whilst the disintermediation risk is, as you said, a kind of business risk, one of the things that we face quite often, or we at least have to think about, that sometimes fintechs don't, is that we really have to, as a big bank, bear the burden of protecting the consumer in a way in which it kind of has a higher threshold, because regulators expect us to do that. I think that there are many situations in which we would argue that a client has done something and shared their credentials with some agent that carried out some very bad things, where we could really make a technical and legal argument. It wasn't our fault. But really, what we really have to make the calculation of is, if we are in court as the bank, with all of us with our bank badges on, are we going to be able to defend that position in the kind of a court of public opinion? And often the answer is no, which means we have to be much more strict about a client protecting their own data than they often think about themselves. So it's a massive problem that we really think about. And I suppose, Jane, I don't have an answer for you. All I'm really saying is that we are thinking not only about the business risk of losing business, but about the risk to that client and the blowback on us of that risk kind of materializing. So it's a really, really big problem for us to think about.
Okay, well, amazing evening, amazing panel. Please, round of applause for both Michael and Pesh. Thank you for having us. And get some drinks, and Eddie will make the plug for Flinks.
Yes, exactly. We couldn't spend the entire evening without it. No, but appreciate everybody. The panelists, thank you so much for coming. A great conversation. I think the two things I would take away is, if I had my CFO in the room, we're going to sign that enterprise deal, whatever the cost. So we'll have to tell him that later. And then also find your champion internally. And I think that's a really big a big win for fintech and bank partnerships. At Flinks, as an embedded finance platform, for those of you that don't know the name Flinks, it's actually the financial links between fintechs and financial institutions. So we truly believe in a world of where you can interact with financial products and services from your app, from your accounting platform, from your construction management solution looking for a loan. And I think these types of partnerships between startups, fintechs, and everything in between is the future of the Canadian ecosystem. So appreciate everybody for tonight. This room is curated with bankers and fintechs alike, so please enjoy the food, the wine, the beers, and I would have to mention thank you so much to Rachel for putting on the entire event. Thanks, everybody.